Hi, good evening. Hi, this is Ming Hon, your host for Traders Talk. And good evening, good evening. Okay, great. Good to see you guys again on a Tuesday evening. And we're going to share some great stuff today, some things about the market, and also the topic today, which we'll share bear market equals to payday. And I'll explain later on what's the thing about. And okay, do you see my screen flickering or is it only me? If you see my screen flickering, can you just type type in the message or just give me a thumbs up? Yeah, I think it's gone. Okay, great. Okay, yeah. So yeah, this is a show where we'll talk about nothing else but the stock market. So for those people who are into trading the stock market, especially the US stock market, this is the show for you. And we have lots and lots of things to share. And in the past, we have also shared a lot. You can actually go to our Facebook page to get the past live shows which we had over the past 1 over years, and also if you don't know, we also have a newsletter which we actually send out every Monday. And let me just put up the thing. Yeah, so this is our newsletter which we issue out every Monday, and basically we will cover things like the market, the past week market, and what's the expectation for the current week, and also some form of like training for the stock market or even options. Yep. So these are some of the things which we actually cover. Besides that, if we also have a new channel on our TikTok. If you have not subscribed our TikTok, go ahead, subscribe it, and we'll even share more on TikTok. Yeah. Yep. So that's all the promotion, pre-promotional things for today. Okay. Yep. So the market mini bear rally, mini bear rally was actually a very mini one last week. In fact, I think it's only about 2 days the market actually went up last week, and after that it is a disaster, disaster. And basically we actually ended up where we were the previous week. Maybe I'll just share with you guys the screen. Let me just pull this out. Maybe I share with you guys the screen here. The screen is here. Just a second. Here. Okay. Yep. Hope you can actually see it. Okay. What is this? This is SPX. Okay. So for the market, generally, we will actually cover SPX, which is the S&P 500, right? So this is actually the one of the index which we will actually look at practically every day to actually see where the market is actually going. Yeah. So 1, 2, 3, 4, 5. Okay. So last week, basically, we were at this level, right? Last Monday, we actually opened at this level here. 1, 2, 3, 4, 5. Yeah. We actually closed here. Where's the pen? Brush. Okay, we actually closed here last Monday, right? Last Monday, and basically the price action last week was a mini bear rally for 2 days, and subsequent to that, the market actually collapsed back to the level where we were about 2 weeks ago, at this level, more or less at the, again coming back to the 3,600 level, right? Remember the level where we actually say that this is actually the level, strong support level, which we had in the past week, where we said that this level should not be breached. Is actually holding based on the previous drop from the highs here all the way down here, and of course it was actually holding on here, and now we are actually back again retesting this level. Let me put this up. Okay. So we are actually on the weekly chart, right? It's a daily chart. On the weekly chart, we are actually back to the uh, 200 moving average. We are back to the 200 moving average here. And again, this is how many times? Three times. We were testing this level for actually 3 weeks. One week here, 2 week here, and now we are actually coming back to this level. Okay, so again, the two levels which we spoke of, 3,600 level plus the 200 moving average for S&P 500, and of course, let's see this week whether we will actually go down below. And of course, the chances are big that we can actually come down below 200 moving average this week, mainly because this Thursday itself, we have actually the CPI announcement. That means the inflation announcement, which will be actually made on 13th of October, 13th of October. And of course, what brought us down the last round, last Friday, was actually the jobs report. And if you have actually noticed, what came out of the jobs report is that the jobs report was actually a good report, and in fact, employment is good, and employment is good. That means there is actually additions to the employment. On top of that, the unemployment rate was also not high. Okay, and why did these good results actually brought down the market? Okay, if you actually recall, last month, right, when the Fed chair actually came out and actually spoke more about the rate hikes, what they actually mentioned was they want to actually bring down inflation. Okay, and of course, when they want to bring down inflation, one of the things which they actually mentioned is that they will do whatever it takes to actually bring down inflation from 8% down to 2%. Okay, so one of the way where they actually bring down this inflation is to actually do aggressive rate hikes. That means that they will continue to increase the rate, the what is that, the interest rate, to actually sizzle down the economy, to actually reduce spending, and sizzle down the economy. Okay, and the thing which they said that they will go to the extent that they will sacrifice jobs. That means that when the economy actually comes down, people will actually start to lose their job. Companies' earnings are lower. People will actually get retrenched. They will actually get pay cuts and all this. And of course, when that happened, they spend less. So that was actually what they said. They will actually sacrifice the economic of people, which is their jobs. But when this jobs report came out last Friday, the thing is that people seem to continue to have jobs. They continue to how to say? They continue to actually get hired. And because of that, that actually shows that the economy reaction towards the increase in rate is actually not that big, to the extent that it will actually sizzle down the economy. So that actually gave the market how to say? They gave the market a very scary outlook, to say that, well, because jobs are still good, people are actually having jobs, economy is still good, the economy is not sizzling down, the Fed will continue to increase the interest rate policy, and there would not be any chance for them to actually tone it down. Yeah, the next rate hike is actually expected in November. And of course, the target back then was actually to increase the interest rate all the way to 4.4% before year end, and 4.6% early part of 2023. And the current rate is 3.25%. Yeah, so there is still uh, possibility that higher hikes would actually come in the November one. I mean, the current consensus was 75 basis points, and of course, once the CPI comes out again this week, if the CPI is continuing to be high, then of course the rate hike might even go up to 100 basis point in the November increase. Yep. So that actually gave a very bad market outlook, and of course because of this the market also dip with this kind of news coming through. Yeah. So so that is actually the situation right now. So in terms of trading, of course, I mean, for myself personally, I have actually closed all my long positions, the trading positions for long. I've actually already closed all of them, and I would not actually enter into any further trades for this week until the CPI announcement comes out. Yeah, so that is the situation for the time being. Okay, so the Nasdaq itself is of course below the 200 moving average, and of course for the past 3 weeks it has been actually hovering at about 11,000 points. Yeah, 11,000 points. Yeah, so it is actually hovering around that level for the past I would say 3 weeks. 3 weeks is going up and down. It's going up and down, but you can actually see that 11,000 is actually the level where the price is actually hovering at, and today it's yesterday itself it is 10,926 for the NDX, yeah? Nasdaq 100. Yep. Okay, so of course same story with S&P wait till Thursday to look at the CPI, and of course there are chances that this can continue to actually go down if the CPI does not actually comes down. Yeah, and of course I mean, we have actually also said what are the things that can actually bring down the CPI. Of course, one of the things is the oil, right? Oil price. Although last month it has actually been coming down, you can actually see for the past 2 weeks the oil prices has actually gone back up. Yeah, gone back up. Of course, mainly one of the reason is OPEC has decided to actually cut production, right? And of course with that decision, there was actually a spike in the oil price since last week. Yeah, that was actually decided last week, but of course the market expectation was actually already way back before the announcement last Wednesday was already imputed that they are expected to cut the production. Yeah, and I mean generally the other macroeconomic things like the issues of the war, the issues on the China supply chain, and all these things are actually not still lingering around, right? And of course, because of this, prices can continue to be elevated. Prices can continue to be elevated, and of course, that will also have an impact to the CPI. Yeah, CPI. Okay, so yeah, I mean basically that's the thing, and I do not really expect that the CPI can actually come down drastically. Maybe a bit coming slightly down. Yeah, mainly because of the earlier part of the September months. The results or some maybe lower oil prices and all these kind of things for the first half of September. Then of course, other than that, I do not think that things are actually coming down much. Prices are actually coming down much. Yeah. What do you guys think? I mean, what is your expectation, or what do you feel? Are prices actually coming down? I mean, yeah, in the local country itself, are prices coming down, or inflation is continuing to be higher? So these are the current macro and economy environment which we are in. Yeah, so that's the thing. Okay, so these are the things which we need to actually expect this week. Yeah, chill. Don't go into trades unless you're actually doing how to say doing speculative trades. If you are actually bearish about it, then of course you can still do some trades, but limit the risk, like doing bear spreads, which can actually limit your downside risk and capping your losses to the price which you have actually paid for the transaction. Or of course, you can also try to actually use things like back ratios, which we have also covered in our previous two sessions, yeah, previous two sessions of Traders Talk, and also on our newsletter. We have also covered back ratio. You can use those type of trades to actually so-called speculate a large move, in the as in the either in the QQQs or even on the SPY. Even on the SPY, you can also do those type of so-called speculative trades, which have a low entry price, yeah, low entry price, with limited risk, yeah, provided you actually structure it out according to how we actually how to say, how we actually treat that type of strategy, yeah, because there are actually certain parameters for you to actually do in order not to not to risk too much on the trade. There are actually certain rules for you to actually enter. You have to go and check out our newsletter. Okay, all right. So coming to this week, actually what we wanted to share with you is bear market is actually not everything bad. Not everything bad. In fact, bear market are actually the time where investors actually make a lot of money, during bear markets. Yeah, why I say investors make a lot of money? Okay, of course, when bear market happens, right? What happens is, of course, prices of stocks actually comes down. Yeah, when prices of stocks comes down, what does that mean? Yeah, what does that mean? Okay, that basically means that the stocks becomes cheaper, right? The stocks become cheaper, and of course, certain of these stocks they become cheaper not because they lose their fundamentals, or they are actually making losses. It is also pulled down by the overall market situation. Some of these stocks may also be affected. I mean, right now, of course, the stocks have actually most of the stocks has actually gone down by at least 20 to 30% at the minimum. Even if you talk about good stocks, Google, Microsoft, Apple, Amazon, the great stocks which are fundamentally very strong, all of them have actually come down at the minimum 20 to 30%. Yep. And of course, these 20 to 30% can be a bad thing, and it also can be a good thing. Yeah, it can also be a good thing. And why do I say it's a bad thing? Of course, if you bought it at the highs, right? If you bought it at the highs, and of course, if it comes down, then you'll take a 20% hit. 20% hit. Of course, the good thing is, especially for those people who have actually not entered the market, okay, especially for people who have not entered the market, then of course this becomes an opportunity for them to actually enter the market. And of course, for people who have not entered the market sufficiently, or they continue to invest regularly, then of course it also becomes an opportunity for them to actually continue to average buy in at a low price. Maybe I'll just share with you this thing here. Let me see. Okay, maybe I just share with you this thing here, just to actually show you how it actually works, right? Okay. This is okay. If you look at the S&P 500, right, you can actually see this, right? Okay. If you look at the S&P 500, this is the S&P 500. I'll just move it all the way back to maybe 2000. Okay, all the way back to 2000. Okay, and you see, for that means 2000 basically is for the past 20 years. For the past 20 years, yeah. I mean, depending on what's your age, right? I 20 years. Okay, I just probably came out to work for a few years during this time, right? Okay, so if you look at the 2000, this basically is a 2000 .com crash, right? This was the 2000 .com crash. Okay, we were actually at this level, and when the .com bubble burst, we actually went down here. We actually went down here for to a bear market, and of course, back here was the financial crisis, right? The financial crisis between this '07. I think there was actually a few around here, '07 to '09, '07 to '09, right? There was actually the US crisis, the Lehman Brothers, and all these things actually came around this time. And of course, then subsequent to that, somewhere here, we have a small down market. And of course, this was during the trade wars, US trade wars, US China trade wars in 2018. And of course, this was the drop because of the what is that drop because of the COVID drop, very steep and sharp drop. And of course, now we are actually in a time here where we are having the past 9 months drop because of the current situation right now. Yeah. So if you look at all these drops, right, what actually happens after the drop? After the drop, so the .com bubble was actually from 00 to somewhere here 03. Yeah. So between this was actually 3 years. This was actually 3 years where it actually came down, and then after that it reversed. It went up here for 4 years. Yeah, it actually went up here for 4 years. Then of course from here it actually came down again for 2 years. For 2 years, and subsequent to that, this was actually a very long rally where basically we are talking about a 12-year period, where it actually went up. Yeah. So here you can see short drops, and long recovery, short drops, long recovery, short drops, long recovery. So at any point in time, when you actually go into the market, right? Whether you actually go into the market here, let's say went into the market here, then of course today itself, even though the market has actually dropped by 25%, you are actually sitting at this level up till today. If you are not talking about today, before this level, you are actually somewhere, somewhere here before the drop. Even if it dropped, you are actually coming back to the same level, provided you, let's say, you continue to invest at the, even at the lows, or at the yearly intervals here, you will continue to be at this level even higher. So what this tells us is that bear markets are or down, the how to say the bear markets or market actually goes down every few years. The longest was actually the 12-year period where we did not really see a big bear market, right? But generally, every few years there can actually be a turnaround coming down. Yeah. And of course, if you're afraid of turnaround and not entering the market, right, then that is actually a very bad decision. In fact, when the market actually comes down, that's the time where you actually need to enter the market, because if you don't, right, you would not have opportunity to actually come back to the market at this level. Yeah, imagine when the market actually comes down here, you did not actually enter the market. Where would you actually want to go in? Go in here, go in here, or here? I mean, all these three levels, or even here, is already higher. Okay, it's already higher. So it does not really matter. If it comes down, you can continue to actually go into the market. Of course, you need to actually so-called tranche out your investments. That means you don't go in at one time, because of course the thing which we do not know is whether this is the bottom, whether this is the bottom, or whether this is actually the bottom. We would not actually know where the bottom is, but of course if you actually follow certain principles, right, how to say, you would probably catch prices at very good levels. And of course one of the ways is actually to go for, say, um, too many lines. So go for actually weekly moving averages as an indicator, where you should actually so-called uh, and make your entries at weekly moving 200 weekly moving average. Yeah, 200 weekly moving average can be one level where you actually start to enter the market during how to say, during bear markets, yeah, to be safe lah. Of course, if you might go into a situation where it don't even go down to 200 moving average, right? Like for example here, it only moved to 50 moving average, and it actually goes up, right? So that is actually the other risk is that you might not be able to actually get it, and the market has already rallied up if you actually wait too long. Yeah, but at the moment, we are already sitting at 200 moving average for the index. Yeah. So I mean, at the end of the day, how to say, these are already good levels. Even if it actually goes down, right? Even if it actually goes down, the how to say, the chances of it going back up in the next 1 year, 2 year, 3 year, yeah, it's actually also quite high. Yeah, because generally the economy will expand and recover over time. Yeah, I mean, if you're talking about things like nuclear war, end of how to say, nuclear war, end of the world, and all these kind of things, where the market goes down to zero, right? I mean, that is nothing to talk about. But generally, if things are so-called normal, then of course, market will always recover. Yeah. Okay, so of course, then the next question, of course, people would actually ask is, how do I actually choose what company to actually go in? Yeah, how do I actually choose what companies to actually go in? And I mean, the answer, of course, there are many stocks. Which are listed on the stock market. Yeah, stock market. But quite simple fundamental things which I always share to people is that, I mean, a lot of things we don't really need to actually think. Don't really need to actually think a lot. And of course, you can study the stocks. You can actually do fundamental analysis and all these kind of things. But of course, how to say, that can actually also take a lot of time. I mean, a lot of people are actually very busy, right? I mean, personally, a lot of people don't really have time to actually look at so many things, to calculate things on top of whatever they are actually doing. So one very simple thing is, of course, go on the big names which you are actually familiar with, big names which you are actually how to say, are comfortable with, big names which are the things that you actually use daily, things that you actually use daily, and things that you are comfortable with, and you would not think that you would stop using their services. You will stop using their services. Yeah. Okay, and these are just some of the examples of companies which of course big companies like Google. Yeah, I mean, Google is actually one of the top companies where you should I mean, I would not say you should. I would say a lot of people actually have in their so-called portfolio. Google, Microsoft, these are the things that you actually use every day. Companies continue to actually buy their products or subscribe to their products. Visa. I mean, on the payment side, right? I mean, Visa is actually one of the biggest payment credit card company, payment processing company. Amazon, yeah, Amazon, of course, on the business of e-commerce, on the business of this what is that, cloud services and all. Yeah, they are actually the biggest. Nike, sports apparel, and then of course companies like Boeing. Boeing, of course, have over the past few years more bad news of the plane crash and all these kind of things. But of course, the level of price which it has actually gone down towards the current price of $100 over is already quite low. So this can be a bit more speculative. This can be a bit more speculative, but of course you can mix your so-called portfolio between good companies with a little speculative, how to say, things inside is also good, because that can actually give you additional returns, right? And then companies like United Healthcare, in the healthcare industry, everyone needs healthcare, right? I mean, everyone grows old and they basically needs healthcare. So these are the companies which, I mean, over time it will continue to grow, maybe not at that speed, but of course when the things are not so good for all these companies on the like the tech and all this, then of course the opportunities on this sector would actually be much more. I can also share with you how the um, current level of prices of, say, United Healthcare as compared to to the rest. I mean, all the rest you can actually see that the stock prices is actually coming down, whereas you can actually see healthcare stocks like United Healthcare has only been going down even during this pandemic. Yeah. And of course, yeah, right now, iShares, you can also go into ETFs like S&P 500. You can actually go to SPY as an ETF, yeah, because currently it is actually trading about 360, yeah, 360, down by about 25%. And of course, you can also go on other ETFs like the healthcare ETF or any other ETF offered by either S&P or even BlackRock. Yeah, those are the sector ETF. You can also look at it if you do not want to go into any single individual counters. Yeah, single individual counters. So again, make things simple. Look at some of these stocks, or even stocks outside here, things that you are actually comfortable with. There are many other brands and products which you use, and of course look at the current prices right now on the charts. Where are they? And of course, if you can actually spot anyone at their 200 moving average, that can also be a good buy in. Yeah, a good buy in. Okay, let's just maybe share again on some of these stocks, right, to look at where they are right now. Let me see. Okay, let's see. Google. Okay, Google. If you look at Google, right, so now again, like I said, 200 moving average is one level where you can actually look at. When it comes down to 200 moving average, that can actually be a safe entry for fundamentally strong stocks like Google. If you look here, was actually the COVID crash. 200 moving average. We are closing 200 moving average right now. And of course, if you look at the past years, like say, if we move back to, let's say not so long back. Okay, let's say 200 moving average was only started here. Okay, maybe not 1 week. Yeah, so hardly it goes down to 200 moving average lah. So since 2020, one time here, one time here. If you move back, you don't even see it coming to 200 moving average. So of course, when it comes to 200 moving average, it's a rare, I would say rare opportunity that it comes down to such low levels lah. From its high to here, basically, you're talking about 150 to about 100, basically about 30% down, 30% down. 30% so-called discount from its high. So Google, Microsoft again, Microsoft hardly coming down to 200. Now it's actually already close to 200, close to 200. Hardly coming down with it. Now it's close to 200. Then Amazon. But of course, if you wait too long, it might not even come down to 200. Yeah. Amazon is already below 200, and of course, right now you can actually see if it's below 200, then of course one indicator which you can actually use is to try to see if it comes back to its previous low, which was somewhere around $100. Yeah, $100. Currently it's 113. One bad day on CPI announcement can already bring it down to this level. Yeah, but of course, I mean, if it shoots down sharply on news, then of course it can also bounce. It can also bounce back up sharply, sharply lah. Like you see, like all the previous drops, right? It goes back up very sharp drop. It recovers. Sharp drops, it recovers. So. The good thing is the sharper the drop, the better it can be. Unless it is actually a sharp drop because of certain really so-called bad news in terms that will actually affect its fundamental. Then that's a different story. You might not want to actually how to say enter because the fundamentals of the company have actually changed. If it's a sharp drop, just because the market have actually dropped and it pulled it down because of market sentiment, right? And nothing has changed to its fundamental, then of course that is going to be an opportunity. Okay, so what else did we talk about just now? Okay, we talked about Visa. Yeah, Visa. Visa is already below 200, also below 200. And of course, like I said, when it comes below 200, you try to actually look for previous lows. If it actually can come back to its previous lows here. Yeah, this was actually about 175. Yeah, 175. Yeah. Then what else did we talk about? Microsoft, Google, Amazon, Visa. Okay, we spoke about UNH, right? The healthcare one, right? Okay, look at this healthcare. Okay, when all the other stocks are actually on the downtrend, right? When all the other stocks are in the downtrend, look at this stock. Okay, disregard all that is happening in the economy, disregard war, disregard everything. So this sector is actually continuing to actually go up. This sector is actually continuing to go up. Yeah. And of course, again, for this company, right? For this company, you can actually see that the opportunity is slightly different from the rest. On weekly, basically, we are actually always sitting on weekly 50 moving average. 50 moving average, yeah, 50 moving average. And now again, we are sitting at 50 moving average. And there was actually multiple times where it was at 50, 50, 50, 50, and it actually bounced up. It can only continue to go up. And of course, United Healthcare, the higher interest rate would actually be also better for United Healthcare because it collects money from people, and part of the money they also put into what is that, savings or bonds, right? Or bonds, right? That can actually yield higher rates for it, generate higher income or return for it. Yeah. So United Healthcare is one of the stocks which continue to actually go up. If you look at daily, I think it's sitting at 200 right now. Yeah, slightly below 200. Yeah, again, 200 always posts a strong support. Daily 200 and weekly 50. Yeah, daily 200, weekly 50. You can use both of it. And of course, the last time it came down to 200 moving average was here in 26th of September, right? 26th of September, um, where it went back up here, bounced back up here. Yeah. So of course, timing wise, I would say hopefully more bad news can actually come on Thursday to actually bring all these stocks to even lower prices for better entry. Yeah, better entry. Yeah. So these are the things. Of course, the difference. How to say, for purposes of longer term investments, you can actually work on entering at lower prices, or even doing dollar cost averaging to lower your cost if you have already entered into some of these stocks in your portfolio at higher prices. Then of course, when the prices actually comes down, you can actually get get more of those stocks. Okay. The other thing, of course, is if you avoid the bear markets, if you avoid the bear markets and you are already invested, say for example you have invested in Microsoft, and you have actually bought it at say $325, for example, and today you can actually get Microsoft at 260. Okay, so again, 30%, 20 over 30% drop, right? 20 over percent to 30% drop, and you want to avoid the buying more. You want to actually avoid buying more. So if you avoid buying more, what will actually happen is that even if Microsoft actually goes back up, right? Even if Microsoft actually goes back up, you will actually take longer for you to actually get back to the position where you were previously for at 325. Yeah, but of course, if you continue to invest at good prices, right? Continue to invest at good prices. So the prices of stocks which you actually buy at a lower rate, right? Lower rate will actually help you to get back get back into profits faster for the value which you have actually lost for the stock prices which you have actually bought earlier. Yeah, make sense? Make sense? Yeah, make sense. So that's the thing. Not to how to say, avoid bear markets, but in fact, try to actually see opportunities within bear market, because bear market are investors' payday. And if you look at the past history, right? Not very often you actually have a big drop in the market of over 20%. Yeah, in fact, if you look at what I've actually shown you earlier just now, right? There was probably uh, four instances or maximum five instances over the past 20 years where you will actually see this kind of opportunity. And of course, today itself, this opportunity is again presenting itself to you. Whether you want to actually take it or you don't take it, it's entirely by choice. But of course, if you take it and if you have the mindset of investment in good companies, safe companies, fundamental strong companies, I would say the risks are actually quite risks are actually low. The risks are actually low, that the prices won't actually recover in the longer term. But don't expect it to happen actually in 1 year, short term, or the next day kind of thing. Then of course, you this is actually more for long-term investments. Then of course, you actually use a different mentality to actually do it. If you actually want to do short-term gains and all, then of course, you would actually do the other way, which is actually by using trading, by actually trading to actually benefit from this kind of movement. Yeah. So that's all which I actually want to cover this week. Hope that you get the best out of the bear market, and don't be afraid to actually embrace the bear. In fact, love the bear, hug the bear, kiss the bear. Yeah, because at the end of the day, the bear will actually make you a lot of money going forward. Yeah. So if you have any questions, post on Facebook. We will get them answered. Otherwise, send us an email. We would be most happy to actually help you in case you actually have any questions or any problems in terms of your trades. Yeah. So until next week, I catch up with you guys again, and happy trading. Have a safe trade this week. Try to avoid, if you can, just look at the market for entertainment this Thursday, to see how the market develops, and then of course from there, if it gives you an opportunity to actually enter on a longer term great stocks at great prices, then of course by all means go ahead without any hesitation. Okay, until then, bye bye.